So moving forward then, I know that with market force analysis, you make predictions for your clients, not only in the near term, but also the long term. If I could ask, where do you think gold and silver is going to be at the end of the year? And then maybe what is your projection for 2011? And then as a follow-on question to that, at what point do you envision there being a disconnect between the paper price of gold and the physical price, similar to what we saw in 2008, where the price of gold plummeted, but the premiums in the physical market skyrocketed. So the actual price to purchase 1 ounce of gold or to purchase 1 ounce of silver was much higher than the paper price.
Well, I see right now we are going into a strong up leg, and I think we're going to accelerate. And I think a lot of people will be surprised at how far gold and silver will go. Price predictions are difficult, but I think that we're going into a physical market squeeze. That this move up is not driven by the paper market, the COMEX, as it has been in the past. This is more and more large investors, central banks, asking for real metal. We've seen Russia announce that they've increased their gold reserves. India's bought 200 tons of gold from the IMF. China's adding to its gold reserves. All these are physical purchases. And from my work, I estimate that the over-the-counter market through unallocated accounts has probably sold 45 times more gold than they actually have in the vaults. And that means that, at some point when more and more people are asking for gold, there won't be any. Because we're not just talking about 45 times more gold and we're talking a few thousand ounces. We're talking in the region of 50,000 tons. And to put that in perspective, that's equal to about all the gold reserves left to be mined on the planet. So there's no way that amount of paper gold can be delivered upon. It's just impossible. So as that starts to become evident to the general public and investors, there will be a gold rush like we've never seen before. And that will then decouple paper gold from real gold. That no one will obviously accept paper gold when they realize that it's not backed. So you can actually see where the price could go. So I'll answer your question on price for the longer term, and that is, if you imagine you're buying from a bullion bank, and he's selling you 45 ounces, and you think those 45 ounces are in the vault. Well, 45 ounces at $1,350 an ounce is $60,000. But if he's only got 1 ounce in the vault, if you were the bullion banker, what is the 1 ounce you've got worth? Well, it's worth $60,000 because you've received $60,000, but you only have 1 ounce. And you can compare that with the U.S. gold reserves. Although the dollar is not backed by gold, you cannot redeem it anymore. The collateral which the U.S. dollar is issued against is the U.S. gold reserves. And you can see that on the Federal Reserve's balance sheet. There's $11 billion of gold certificates, which is the 261.5 million ounces at $42.2 an ounce, which is the U.S. Treasury's gold. And that is the collateral for issuing dollars. We've issued $13.5 trillion if you take the M3 number, and 261.5 million ounces of gold as the collateral against those bills gives you $56,000 an ounce. So almost the same number. So that, I think, is the long-term target for gold, because that defines the US dollar. And at some point, the free market will get to that level once the 45 ounces of gold that don't exist are not acceptable to anybody.
So is what is good for gold the same for silver? Would you say that the upside potential for silver is equally as good, if not better than gold?
Yes, silver I think at some point in the future may actually trade at a higher price than gold.
Really?
Yes. The reason for that is that silver has been abundant for a long time, and in the earth it's 13 times more abundant than gold. But we consume silver. We don't consume gold. Gold, almost all the gold ever mined in the world in human history is still above ground somewhere. But silver has been suppressed in price, and it's so cheap that we don't recycle it, or we don't recycle a large quantity of it. The silver that's in your cell phone battery or on the connections of electronics or in solder and these sorts of things, ends up in landfills. And so we are taking silver out the ground and consuming it, and it's lost forever. And because we've been doing that for 50 years or so, the amount of silver we have left is getting less and less, and silver is becoming more scarce than gold. At the same time, silver is gaining traction as an investment metal again. And I think you put those two together, and you've got an explosive mix, which means that silver will have to trade at something which is higher than the gold price at some point in the future.
We received an email this week from one of our customers, Adrian, named Dale, and he wanted to ask the question, Adrian, the ideal debt clearing would be when all currencies would be convertible into gold. Deflation could not occur, and inflation would be limited to the additional supply from the gold mines. Since it is apparent governments do not intend to adopt that ideal and limit their power, how does one know what world event will signal that it's relatively safe to convert their money back into paper currencies or instruments in the future, or does one simply never hold paper currencies again in our lifetime?
Well, I think in the near term, there won't be a time when you'd want to convert back into paper. And I think the road we're headed on right now with most of the major currencies is towards hyperinflation. And I think the Federal Reserve is irretrievably on that path. So if you look at cases of hyperinflation like Weimar Germany, like Zimbabwe, there never was a time when you'd want to swap your gold back for the hyperinflating currency. So there never was an overbought situation like we talk about, or many people talk about in today's market. The currency is being destroyed; it's dying. So there is no point in buying it back. And I think we're heading into that direction. So to answer the question, would there ever be a time in your lifetime when you want to hold paper currency? I think that depends on what the end game is. At some point, there will need to be a new monetary system, which I think will in some way be gold-backed. So at that point, it might be safe to convert money back gold back into paper currency. But I think what people have seen over the last 15 years with the cycles in the gold market, I think they've been conditioned to something which is not going to be the case in the future. The large downturns in gold, the $150, $200 corrections, were induced by the central banks. And I don't think that we should take those necessarily as things we'll see going forward.
Since we're on the topic of currencies, last week the BBC News had an article with the heading, "Currency Wars Threaten Global Economic Recovery." And the article begins, "In recent months, a string of countries from Japan to Switzerland, Colombia to Israel have tried to drive down the value of their currencies. Some experts call it competitive devaluation. Others, though, argue that it is nothing short of a currency war, and far from boosting global recovery, it threatens to undermine it." What are your thoughts on this, Adrian, and what impact does this have on precious metals?
Well, import and export is a zero-sum game. There must be an export for every import. So obviously, all countries want to export. Or increase their exports so that their increased GDP can increase their tax revenues, start to pay down their debt, and get them out of their financial difficulties. But obviously, the whole world cannot export their way out of their problems and export their way to prosperity, because someone has to be a net importer. But the behavior of the countries today is they don't care as long as it's not them that's the net importer. So they want to devalue their currency to make their exports more attractive. And, that is creating this currency war, which no one can win because, there is no differentiator. When you have countries that have certain advantages because they have cheap labor or they have a well-educated labor force, these sorts of things, then you can compete in the world market and you can be a winner in the export game because you can beat everybody else. But when the way you're competing is devaluing your currency, well, the next guy can just devalue a bit more. And then what are you going to do? Well, you're going to devalue a bit more. So there is no way to win. The end game is everybody has zero purchasing power currency.
We touched a little.
And to answer your question about the implication for gold and silver, clearly, that is the way you're going to protect yourself from these currency wars. You can't do that with gold and silver. But the paper currencies will be devalued to a very low purchasing power, if not zero.
One of the hottest debates today in the market is this debate between whether or not we're about to enter into a period of hyperinflation or deflation. And I'd like to close this interview talking a little bit about this topic, as it relates to the global economy and also specifically to the metals. And I'd like to reference an article that recently came out by Doug Casey by the title of No Way Out. Now, Casey Research is a newsletter that is very well known in the industry, and there are several writers for that newsletter, David Galland and Terry Coxon. And I hope that I don't mischaracterize their position, but I have always been under the impression that they have been very strong of the opinion that hyperinflation is coming down the pike in the not-too-distant future. I find this interesting because in the article that Doug Casey wrote last week, he had this to say: "Over the years, I've been agnostic as to whether this depression would be inflationary or deflationary. At the moment, I'm leaning towards a deflation in most areas. Why? Because the purchasing media in the U.S. is primarily credit-based. If a mortgage defaults, what happens to the dollars it represents? They literally disappear, which is deflationary. If a bond defaults, the same thing happens. If stocks and property prices crash, the dollars they represent vanish. If people or businesses don't borrow, the money supply fails to expand. In fact, many are trying to pay back loans, which is deflationary. Even so, contrary to popular opinion, deflation is much better than inflation." I'd like to get your thoughts on this, Adrian. And he goes on to talk a little bit about Weimar and Zimbabwe and saying that the situation is a little bit different there because you didn't have a situation in which debt was the driving force behind new currency being injected in the system. So what would you say to Doug Casey?
Okay, I think people use the terms incorrectly, and then once they've used the terms incorrectly, they say, hey presto, that means we've got deflation. So when you say something's deflationary, you're obviously going to come to the conclusion you're going to get deflation. So the way I look at it is there are the monetary system and the economy can operate in inflation or disinflation. In an ideal world, we should be having the money supply growing or shrinking at the same rate at which the supply of goods and services to spend it on is growing or shrinking. And if you don't grow at the same rate, and which would give you stable prices, then you will have inflating prices or disinflating prices. Notice I don't use the word deflation. And you get that even under a gold standard. When the Spanish were bringing gold from Latin America to Spain, they had huge inflation because of the large increase in money supply, which was gold, which just meant the general price level went up. Those are the operating modes of the monetary system. There are two failure modes of the monetary system. One is hyperinflation and one is deflation. So you can't talk about, for example, Japan being in deflation for 20 years. You can't be in a failure of the monetary system for